Hey everyone, welcome back to Corporate Decoder. Today, Boot Barn Holdings Incorporated Boot just filed their definitive proxy statement, and I'm seeing some really interesting numbers around executive pay and future growth plans. Quick note, this is not financial advice, just my take on public filings for educational purposes. This filing gives us a peek into how the company plans to reward its top executives and what that means for its future stock performance based on growth strategies. Alright, let's dive right into this proxy statement from Boot Barn Holdings Incorporated, filed recently. This document is basically a guide for their annual stockholders meeting, where important decisions are made. Think of it like the company's report card and roadmap all rolled into one. First up, they're asking shareholders to elect 8 directors. These are the people who make the big decisions for the company. We see familiar names here like Peter Starrett, who has been with the company since 2011 and is the chairman of the board. He has a ton of experience in retail, even founding his own advisory firm. The filing mentions he served as executive chairman on an interim basis for a while to help with transitions. This role suggests a deep level of involvement and confidence from the board in his leadership. And of course, John Hazen, the chief executive officer and a director who has been with Boot Barn since 2018 and took the CEO role in May of 2025. His background in digital strategy and direct-to-consumer sales is clearly seen as a key asset for the company's evolving business model. Lisa G. Laube is another director with extensive experience, particularly in merchandising and operations, having held leadership roles at companies like Floor and Decor and Party City. Her background in retail leadership is super important for guiding the company's ongoing expansion and product strategy. Now, this is where it gets really interesting. Shareholders get to vote on executive compensation, often called, say, on pay. This vote is advisory, meaning it's a recommendation, not a command, but it sends a strong signal to the board about how shareholders feel about the pay packages for the top executives, the named executive officers or NEOs as they are called here. The compensation discussion and analysis section really breaks down how they decided on these pay packages, and they tie a lot of it back to the company's performance. For fiscal year 2026, they reported some impressive numbers. Net sales jumped nearly 18% to over $2.2 billion. Same-store sales were up more than 7%, and net income increased by a solid 25%. They also opened a bunch of new stores, expanding their footprint significantly. For fiscal year 2026, the CEO John Hazen's total compensation was over $6.6 million. Most of this, about 84%, was variable pay tied to performance and company stock. The Chief Financial Officer, James M. Watkins, saw his total compensation reach about $2.8 million. Lori Grujalva, the Chief Merchandising Officer's pay was around $2.3 million. Jonathan Kosoff, the Chief Digital Officer, earned about $1.6 million. And Michael A. Love, the Chief Retail Officer, also had total compensation around $2.3 million. Looking at the summary compensation table, a big chunk of this pay is in stock awards and non-equity incentive plan compensation, basically bonuses tied to company goals. For instance, John Hazen's stock awards alone were over $4.1 million for fiscal 2026, with another $1.6 million in bonuses. Then we get to Proposal 3, asking stockholders to approve the 2026 Equity Incentive Plan. This is more about the future. The company wants this new plan to help them attract and keep talented people by offering equity incentives. The idea is that when employees have a stake in the company's success through stock options or awards, they're more motivated to drive the company forward. This new plan would allow them to grant up to 1 million shares of common stock, plus any unused shares from their previous plan. As of the 1st of July 2026, there were over 1 million shares still available under the prior plan. The potential dilution from these new shares is about 3% of their fully diluted shares. This is a pretty standard amount. Companies use these plans to make sure they can offer competitive compensation packages. Their burn rate, which is the percentage of shares used for equity grants each year, has been pretty low. For fiscal 2026, it was about 0.42%, and the 3-year average is about 0.6%. This shows they are not overdoing it with stock grants. Finally, Proposal 4 is about ratifying Deloitte and Touch LLP as their independent auditors for the fiscal year ending March 2027. This is pretty standard for publicly traded companies. They paid Deloitte about $1.4 million in audit fees, tax fees, and other costs for fiscal 2026. This is a normal cost of doing business for a company of Boot Barn's size. Now let's look at who owns the company's stock. BlackRock Incorporated owns a significant chunk, about 15.6%. Vanguard and FMR are also major players holding substantial stakes. When you add up all the shares owned by the directors and executive officers, they hold about 0.7% of the company's stock. While not a majority, this is a decent amount, showing they have a vested interest in the company's performance. This section details any transactions involving company insiders. In Boot Barn's case, it seems the most notable item is related to Lori Grijalva, Chief Merchandising Officer. Her husband works as an independent sales representative for suppliers from whom Boot Barn purchases a lot of merchandise. The company purchased about $37 million worth of merchandise from these suppliers in fiscal 2026. While her husband earned a good chunk of commissions, this kind of relationship is often scrutinized for potential conflicts of interest. However, the company does have a policy for reviewing and approving these types of transactions to ensure they are fair. This part tells us when shareholders need to submit proposals for future meetings. For the 2027 annual meeting, any proposals need to be submitted by March 2027. Let's circle back to that equity incentive plan. This is the appendix laying out the actual rules of the plan. It details how many shares can be granted, which we saw is up to 1 million shares plus whatever is left from the old plan. It also outlines that shares bought back won't be added back to the pool, which is a good practice that prevents excessive dilution. Also, crucially, it states that no options or stock appreciation rights will be granted at a price lower than the market value on the grant date, which is a common check to prevent abuse. The audit committee reports that they've reviewed the financial statements with Deloitte and Touch LLP and found everything to be in order. This is a standard sign-off for financial reporting integrity. This section tries to show how executive pay lines up with the company's performance. They compare compensation actually paid, or CAP, to things like total shareholder return, net income, and their chosen measure, consolidated EBIT. For 2026, their chief executive officer's compensation actually paid was over $11 million. This is significantly higher than his base reported compensation due to changes in the value of outstanding equity awards. What this tells us is that a large part of executive pay is tied to the fluctuating value of company stock over time, not just the salary or bonus awarded in a single year. The company's total shareholder return, or TSR, is presented against a peer group. This is a key metric to see how the company is performing relative to its competitors. When comparing executive compensation to consolidated earnings before interest, taxes, depreciation, and amortization, or EBIT, the story is a bit mixed. While EBIT has generally trended upwards, aligning somewhat with pay, the big swings in executive pay are often driven by the valuation of equity awards granted in prior years, rather than the current year's operational performance alone. This is a common feature of stock-based compensation. Revisiting the equity plan, the company is asking to approve this new plan to enable them to continue offering competitive equity incentives. They highlight good governance practices like no evergreen share reserves, which means they cannot automatically add more shares to the plan without a new shareholder vote, and no repricing of options without stockholder approval. These are important safeguards. And finally, the auditors Deloitte and Touch LLP is recommended again. This is pretty standard stuff, just confirming confidence in the current auditors. Overall, Boot Barn Holdings Incorporated's proxy statement highlights a company with solid financial performance driven by strategic expansion and a focus on digital growth. The executive compensation, while substantial, is largely tied to company performance and stock value, with safeguards in place in their new equity plan to protect shareholder interests. The biggest risk I see is the complexity of stock-based compensation, where executive pay can fluctuate significantly based on equity valuations, sometimes obscuring the direct link between current operational performance and pay. What I am actually looking for is how this new equity plan will be utilized in the coming years to drive further growth. That is my take. Stay decoded. If you found this analysis helpful, please like and subscribe for more decoded corporate filings and join our community through the Discord link in the description.